Well, EM equities have recovered a little bit over the last month and a half. The significant underperformance that they had relative to the DM equity world seems to be tapering off. Uh, Having said that, if you look at most of the indicators, as in GDP growth revisions, they are down for EM equities. And you look at earnings revisions momentum, they are very weak for EM as compared to DM. And you look at monetary policy, it's much tighter in the EM world with Brazil, India, China also, following a tighter policy regime. So monetary conditions also favor the DM world. Having said that, there is a chance for a tactical rebound in EM going into the fourth quarter of this year. That's supposedly a tactically, seasonally stronger period for EM equities. Having said that, we'll see how the growth dynamics play out over the next month or two before getting more bullish on a sustained basis for EM equities. Yeah, EM equities have seen quite significant outflows. If you look at EPFR flows, then since March this year, they've seen almost about $50 billion of outflows from EM equities. Contrast this with 2008 when we lost about $51 billion, 2011 when we lost about $50 billion. So outflows have been fairly significant, partly driven by the fact that growth dynamics have improved in the DM world, and partly because of the fact that EM itself has kind of struggled with the leading emerging markets like India, Brazil especially coming under pressure. The flow pattern we think is also very closely linked to the US Fed rate cycle. And if the US does decide to taper aggressively, you could see more flows going out of the EM world. But if not, then flows should stabilize, and at some point in time, they could return to the EM world. Well, actually, the G20 meeting over the weekend did not show a lot of great deal of support for strikes against Syria. And of course, President Obama has chosen to seek congressional approval, and that should play out this week. The strike itself is probably not as significant as the after effects of the strike, i.e., is it a short strike? In case it is a short strike, then oil should come off. But if it is a prolonged strike and the way in which Syria retaliates, that's going to be very important. If things get messy over there, then oil can easily spike up another few dollars, $125, $130 range. Having said that, there are a couple of positives which can emerge. One is if the US does decide to take military action against Syria, we expect the strategic petroleum reserves to be opened up to release more oil into the system. And at the same time, you expect the Saudis to increase production of oil to cushion a significant jump in prices. Well, gold, essentially with interest rates going up, the attractiveness for gold, especially in countries which have current account surpluses, has obviously worn off. But for economies which have large current account deficits where there are both fiscal as well as current account problems, gold would probably still remain attractive from a domestic savers perspective. However, institutionally, if interest rates are higher, it would basically mean that the demand and the allure for gold is going to go off.